evening, and welcome to the first roundtable discussion of the day, Ferrous Scrap, the highs, the lows, and the flows. And to take this conversation forward, we have with us Sean Davidson, the founder and CEO of Davis Index. The company's team of 50 plus experts based in the US, Canada, Mexico, India, Ukraine, and Singapore deliver over 1,300 price indexes from across the world. At the start of the last decade, Sean reinvigorated scrap coverage across the Metal Bulletin Group as global editor of raw materials at American Metal Market, Metal Bulletin, and Steel First, based out of New York. In 2015, he moved to Houston to build and launch Argus Metal Prices as its global editor, a role he left in early 2019. Since then, he has focused on building Davis Index into an industry leader for scrap market intelligence. Over to Sean Davidson.
Thanks, Rayla. And good day to you, wherever you are based. I come to you like Josh out of the US. I'm in Houston. Josh is in New York. Wade's representing Europe. And we have Nathan, who will join us in a little bit with some technical difficulties also out of New York in the US. And we're obviously gathered to discuss ferrous markets. And I thought what I'll do is I'll do a very quick introduction to Josh and to Wade. So Josh Toney is with Freight Investor Services. I'm sure you've seen that as you signed up. Just to give you a little bit of background on Josh, Josh is a steel derivatives broker at FIS, which is, for those of you that aren't aware, a leading freight and commodity brokerage. He was previously a senior trader at DJJ, which is David Joseph, owned by Newco, and was managing a multi-million-dollar monthly trade book there before he moved to FIS. So he brings a lot of experience, because he's done physical brokerage. He also brings a lot of experience with financial trading of steel and scrap derivatives. So I'm actually quite excited that he's on this panel. I have a lot of questions for him, because obviously ferrous derivatives have taken a lot longer than non-ferrous to take off. So hopefully we'll get some more ideas on when he sees that improving. As for Vedprakash, Lata is with Gemini Corp, a massive company, trading company out of Belgium. He is a senior board member and a director at that company. I think Gemini has 33, maybe 34 affiliates worldwide. Wade himself carries about 20 years of experience in international trade, and Gemini manages about 2.3 million tons of recyclable raw material trade worldwide annually. Wade quite recently was invited to the WEF, which is the World Economic Forum in Davos in 2020, to advocate for the need of recycling and push forward an agenda for circular economy and sustainability. I've had the pleasure of knowing Wade for a long time, and it's one of the, also along with all his accomplishments, he's also one of the nicest people you could meet in the industry. So I look forward to hearing Wade's inputs. And we have Nathan, who has joined. He's still on mute, but he's made it. So technical difficulties be damned. We have Nathan with us finally. So let me introduce Nathan. So Nathan is the founder of Idoru Trading, an independent trading agency, a trading and agency company for ferrous and non-ferrous. He is also the principal of Idoru Trading and Consult, which is basically oriented towards servicing export, companies that want to export, scrap companies that want to export. Prior to this, of course, Nathan gained all his fame and notoriety as a senior ferrous scrap trader at Hugo News Schnitzer Global Trade. So he was there for a long time. He's been involved with bulk trade for decades, knows way more than most of us will ever know when it comes to bulk trade. He began his career back with Mark Rich and Co. in 1984. And in 1988, he was transferred to London, where he helped build Mark Rich's, which later became Glencore. He built their European ferrous scrap operations. So he's basically been involved in developing, transshipment terminals at Rotterdam, Amsterdam, Antwerp, Gdansk, Nikolaev, and along with a lot of the work that he's done in the US. He is known to many in the industry as old school. I disagree with that. I know him. He's very new school, very modern, and is a trusted partner to many scrap recyclers and steel mills worldwide. So with that, we can kick off our discussion. What's been interesting about this format is that we're just here to have a discussion, right? I don't think anyone's prepared slides. We're not going to, bore people with presentations. We're just going to have a discussion. So, I can go by a bunch of questions that I have, and I think maybe that's a good way to kick it off. And then obviously for you, Josh, Wade, Nathan, we can jump into anything that you find pertinent or pressing that you'd like to, sort of wade into. But I think that let's just talk, since we're kind of like gradually coming out of COVID, right? Or maybe at different paces, depending on the different countries, let's talk about that for a second, right? And let me ask you, so to what extent has the supply of and the demand for ferrous scrap stabilized, or maybe not, right, after all these COVID-19 related disruptions? So, I think, Wade, let's talk to you since you have a large trading position, right? So, how did it impact trading? Where are you seeing it still struggle? Where are you seeing it improve? And then from there, we can take it to Nathan. And then, Josh, you can let us know whether COVID, translated into some more activity in terms of hedging, right? So, Wade, let's start with you.
Right. Thank you, John. It's an interesting question. And this is a question I always get in all the panels I have been into and in all the conferences I attend to. The basic.
Fine, then we won't ask you. We'll try to be different.
Right. The basic underlying thing in the scrap business is the total volume of internationally traded scrap, and that hovers around 100 million tons for last, I think, almost 20 years. Sometimes it's 105 million tons, sometimes it's 115 million tons. In 2020, it went down to 85 million tons. So this was obvious in last year that the scrap volume went down. It did not go down because there was not enough scrap available. It did go down because there was a standstill in first 3 or 4 months around the world. Nobody knew how the trade is going to affect how the logistic is going to affect the trade, how the banking is going to affect the trade. So there was almost a standstill. In my case, for example, for last, I think from February, March, April, we shipped only 20% of our volume than what we used to do in last year. So yeah. Across the board, there was this decline because of this confusion. But afterwards, the trade picked up. And I think from June onwards last year, or even May onwards till now, the scrap business has been normalized. Scrap traders have a tendency to always complain. The buyers always complain that there is not enough scrap. The sellers always say there is not enough prices in the market. But if you see the volume on
traders always complain there's not enough margin. Yes, okay.
Indeed. But I always complain for one thing, that there is not enough volatility in the market.
Yeah. Fair enough. But wait, let me ask you this, right? So I know that you're saying, okay, fine, and we know this, right? Like overall volumes increase. So actually, if you look back the last 12 months, it's looked fantastic, right? But we know that some of the impacts of COVID were container freight rates soaring, right? I mean, right now we can see some outages in South China, which have again delayed. So why don't you speak to that? Because that's a real issue that's not going to go away anytime soon, right? And you're fixing boxes across the world, right? What has that impact been like for you?
So very interesting question. Again, we handle around 130,000 containers on annual basis. So that's approximately 11,000 containers on monthly basis from 234 port pairs. Over last many years, I have just made a small calculation that how much was the scrap, how much was the logistic cost attributed to the final steel scrap prices, and that comes around 20% thumb rule. It is still the same. So today the scrap prices have moved up, but there is also because the logistics prices have been embedded in that total price mechanism. So if we compare from 2 years ago, yes, the scrap, the logistics prices have been doubled and tripled, but so is the scrap prices as well. So the net impact is zero.
I think anyone would have taken that as a net impact, right, a year back. So, I suppose that's a really positive message. But Nathan, coming to you, I mean, I know that you trade containers. You're an agent for bulk. I mean, what are the impacts that you felt from COVID? And are you seeing any lingering impacts still in the market?
I actually have a very different, or slightly different view on the subject than Ved, and I think that's because Ved looks at it through the lens of the containers, whereas I look at it first and foremost through the lens of bulk, for the simple reason that more tonnage worldwide moves in bulk than in containers. So let's talk about, I mean, supply and demand are really two different subjects. If you look at the supply side first, I've said this many times before, scrap is a product of affluence. If an economy does well, people spend more money, they throw out more, they generate more scrap. Same holds true for plastics, metals, paper, glass, all these recycling products. I think during the lockdowns, less scrap was generated by each household, but there was also less collected and less brought into the yards. And there were also less demolition projects, especially the first few months of this crisis. But whenever I spoke to suppliers, they would always complain that scrap is trickling into their yards. And obviously all this results in much less scrap being generated. So when the lockdown was over, there was a lot less scrap around available throughout the yards. However, when you look at the demand for scrap throughout this entire time, including the first 4 months, as Ved points out, from where I have been looking at this during the last 15 months, I can truly say that the demand for scrap has actually kept up far better than the rate at which it was generated. That's been my view. And I think that is because most steel producers kept on producing during the pandemic. If you look at Turkey, they never really went on a full lockdown like the European Union and like the United States. Instead, they did these mini lockdowns, weekend lockdowns. As a result, they kept on producing. The same with many of the Latin American and Asian markets. They continued to produce. So yes, less people came to the plants, but the melting continued. So the demand was really almost constant from where I'm looking at it again.
Yeah, but Nathan, sorry.
Wait, I'm not done, because there's more to this. I did not sense that the demand for scrap due to the less demand for scrap due to COVID, also the increase and the slowdown in demand for scrap was not much different than other average times of normal average years. And if you look at the volume of bulk vessels that left the EU and the US ports, then there's your answer. For most part, that business kept on turning. So in my it's a different story from the container side, but it's a different story from the bulk side.
Yeah, but Nathan, I mean, like if you look at, Q2 last year, right? I mean, during peak COVID where, there were lockdowns basically across the world, right? India was producing a 30% output, and it was mostly the integrators that were running, none of the EAFs. Turkey went through some long lockdowns. I remember, cargoes getting renegotiated, getting pushed forward. I mean, there was some disruption early last year, right? It wasn't like it was smooth sailing, right? I think
minimal.
That for India, no, I mean, like it was.
But India, I'm sorry, with all due respect, India is not the end all and be all of all the markets. There are other markets on fire, burning, buying scrap and producing steel like South America and in Turkey and in other places. So India is just one segment of the market. I'm telling you, from where I've seen this, if you looked at the vessel schedules that have left US ports in 2020 and so far in 2021, and then compare them with any average year, I don't think you will find a significant decline in export vessels, and I don't believe, despite all the noises made, that there were many renegotiations and cancellations of bulk cargoes. They just weren't. Maybe the exceptional ones. So I look at this from a different angle.
Yeah, fair enough. And did any new markets open up, Nathan, during the time, like over the last 12 months? I mean, South America has been strong for the last few years, so has Bangladesh, but I think, obviously Japan started shipping to Bangladesh. That was one big change that happened right over the last 12 months. Anything else kind of like, new maybe, or a little more surprising that occurred in bulk markets, Nathan, over the last 12 months?
I think we've seen a number of unusual cargo moves, let's say from the United States East Coast or Gulf to certain Asian markets. That, if anything, caught my attention. But again, it's really the exceptional move. It's not the run-of-the-mill, the day-to-day trade that we see.
Okay.
No, I don't really see it. But again, I don't think it was as badly affected. I think we were all very nervous. We didn't know what to expect, and including myself, I thought we'd be facing certain cancellations. But from where I'm looking at it, thankfully, it was not. I didn't see it that way.
Fair enough. Okay. And so, Josh, coming to you, I mean, you obviously approach it from a different lens, right? Usually rising spreads, especially, when you've got $1,000 between HRC and shred and things like that, and rising steel prices globally and rising, usually they become events for more hedging actions, correct? Usually. So do you want to tell us how it panned out for let's start with ferrous scrap, and then you can tell us steel. Steel, kind of like we know what's happening there, but tell us how it's going with scrap.
Yeah. So look, as my co-panelists have mentioned, I mean, there was a lot of, I would say, uncertainty in the marketplace, even on the financial side of the equation, where people are looking at Bush futures, heavy melt futures, and in various markets. I think one thing that ended up happening is, as we learned that the shutdowns were not going to be as aggregate impactful on the ferrous markets, right? I mean, many of these countries and entities ended up being, okay, these are systematically important to keep running these industries, right? Even during shutdowns in other parts of economies. We saw a decent amount of activity come into the futures market as people realized that, the shutdowns were not going to have as large of an impact on the steel making side of the equation as might have initially been thought. In terms of scrap market growth, I mean, right now, if you're looking for liquidity, your best bet is the LME heavy melt contract. I mean, that's the one that has the most active interest of current trading, which for everyone listening, that's, heavy melt 80/20 delivered Turkey is that price point mechanism. And so I think what has happened is, as Nathan mentioned, we've seen overall bulk trade remain stable. That's gotten a lot of people looking at these products and thinking, okay, pricing looks good, margins look good right now. Historically, I mean, when was the last time we saw almost $500 a ton heavy melt? I mean, it's got to have been, a first for some time since we've ever seen that. I'm sorry, 2008.
10 years
right?
ago, exactly, yeah.
10 years ago, yes.
So, what this has brought in is there's a lot more companies and people involved in this trade on the physical side that are saying, okay, well, there is an opportunity for me to maybe protect from some catastrophic market moves, from stuff that we might have seen during COVID that didn't actually materialize in the true marketplace.
Okay, but so I guess let's ask all of you a question. I mean, we can talk about like derivatives a bit later in the sense of like, what will it take to bring in liquidity, right? Because obviously, the industry is going to try new contracts, listed on new exchanges and see what takes. But let's talk about cost of capital. I don't think it was one of the pre-set questions, but rising prices means that companies either need to raise more capital, right, to have more cash flow to maintain that volume, right? And if you're going to increase the volume, you need even more capital. So, Ved, we can start with you again. I mean, has it been easy, increasing lines with banks? How are they approaching this, commodity super cycle that has now become this new buzzword, right? I know in Singapore, it's still tight and banks are being extremely cautious. What's been your experience?
I think we have to see from different lenses. Many governments issued what they call this COVID extra budgets, this $1 trillion from US and 800 billion euros here in Europe. And many of the governments pushed a lot of extra budget, a lot of extra money to pump into the system. So as far as US and Europe is concerned, we didn't see anything. But interestingly, in the countries where the inflation rate is pretty high, I think there this cost of capital has become a big headache for the countries. For example, in India, the cost of capital per ton is almost $40 to $45 a ton.
Wow.
Today they are making a lot of money, so they can absorb it. But in general, this is a humongous cost. Similarly, in Turkey, the interest rate is almost 11-12%, even more. I've heard even 14-15%. Once again, it was fine because the prices of finished steel has been good and it was absorbing. But in China, this was way around. So the inflation was high. The interest rates were controlled by the government.
Yep.
So the Chinese were caught in between. So you have the high cost of capital. You have a controlled interest rate by the government, and you have a chance to make money, but you were still not able to make that much of money what somebody else could make, and that resulted. And now it's going to further result in some disruptions in the market. So the cost of capital would have some role in creating some disruptions in coming months. That's what I feel.
Okay, Nathan, anything that you'd like to add?
I really haven't heard of any particular buyer on the bulk side, on the container side, having issues or delays with financing. I really did, that subject did really not thankfully pop up on my radar in the last 15 months. Yes, I did hear of instances where on the container side, and Ved could speak better on that subject than me, but I've seen instances on the container side where payments would be late if there was no letter of credit, and where letter of credit, which is few and far in the container business these days, were late. But on the bulk side, thankfully, I did not see any major disruptions on the financial side.
Okay. So one of the questions. So just for the audience on background, I mean, so the panelists, we had a discussion prior to, this session, and we jotted down a few questions that we would discuss, on this call. And obviously, we're open to bringing in any questions and discussing any points that you might raise while you're here. Please feel free to send them in, and we'll be more than happy to discuss them. So one of the questions that we discussed, during our prior meeting, and that we thought would be pertinent, was about China, right? So, the question basically is: will China's shift to more EAF steelmaking, largely be an internal economic story for China, or will their willingness to import ferrous scrap potentially export ferrous scrap? I mean, where do you see that? What do you see that portend for the future? And now I think this time we can start with Nathan, since you participate there.
I think the latter. I think China will eventually import a substantial amount of ferrous scrap, but I think they will seriously need to adjust their contract terms, their quality specification, and penalty structures, because some of these frankly border on lunacy. All this talk in December last year about China starting to buy up scrap as of January 1st, I think was a lot of hype leading up to the new year. Next week, Wednesday, will be 6 months since that landmark January 1 date when China was supposedly going to enter the scrap buying arena with a vengeance, and prices were going to shoot up another $100 to $200. Well, I have yet to see one respectable US or EU legacy supplier ship a bulk cargo to China. They are far better buyers in other respectable and well-tested markets with much simpler, already grandfathered in terms. And like I said, they really need to work on their terms before we will see a lot of sellers running to sell their cargoes to them. But in the long term, yes, I do see them as an importer of a lot of ferrous scrap.
Yeah. So just to be, let's call it politically correct, there have been legacy suppliers that have definitely shipped China. They haven't done bulk, so they haven't done 30, 40,000 ton cargoes, but there've been a lot of suppliers around the world, including Japan, that have shipped some small bulk. They've been, they've booked containers from around the world to China. So I can share some data with you. We've been tracking it. I agree with your view, Nathan, that the song and dance about, oh my God, look at this massive buyer that's going to step into the market, that got everyone buzzing in December, it was all absolute nonsense. What ended up materializing was that, and Wade will know this because I know that they booked some scrap from Gemini, was the fact that basically they came in to buy high grades of scrap, specifically PNS and, what the Japanese call HS, and, what they call recycled steel. It's a different grade. They book containers from around the world, and they're averaging about 60 to 70,000 tons coming in per month of this scrap, right? So it's not a massive volume. I agree. I mean, 70,000 tons is a non-event if you look at global trade, right? So, but there has been some of that, the UK shipped a small bulk, right? Like, so I think they've been testing the waters. It's hard to say what the strategy here is, whether it's, let's test where we can import from and what qualities are available, or whether they're testing the ports to see whether these are potential export destinations in 2 years, right? Like, and who their competition might be. It's very difficult to see what's happening. I personally don't see China being a massive importer anytime soon. I actually think that because there's so much domestic scrap available, it lies unprocessed away from the coast. Focusing on trying to improve their domestic processing will obviously yield, will later on turn into an event where they might actually be able to export, rather than import in a couple of years, right? So I think we are not far from that point now where we can begin conversations about China being an exporter of scrap maybe in 3 to 5 years. I think obviously we're in that period now where, as it increases EAF, basically scrap, even the BOFs, I mean, even the integrators are going to take in more scrap, right? So as we see, every percentage point of China's increase in scrap intake is a massive volume, right? So I think that over the next couple of years, there will be disruptions, right? Where for a couple of months, there will be net scrap short or ferrous units short, right? Where we'll see these little, like, oh my God, now we need all the pig iron. I mean, we need this and we need that, right? And then over time, though, I think it normalizes to they become self-sufficient and then actually have scrap to export. So that's my personal view. Ved, now let's ask you.
Yes, I disagree with you a little bit. Mostly, I agree with you what you say, but
it's good to disagree. We should all disagree. That makes it a fun panel.
Right. Indeed. So I like to present the example of India. So if you take the figures of imports of scrap in India for last, let's say 10 years, it's an average of around 6.5 to 7 million tons. 7 years ago, India was less than 60 million tons steel producing country. Today, we are almost, I think, 110 million tons. So 40 million ton extra capacity and production has been added, but it has not helped the steel scrap industry to import more steel into the country. And so if you take this example and now see what Chinese are going to do, the first impact the Chinese government wants to make on the steel industry is to produce more low emission, more green steel. So that is their main objective. They are not yet focusing whether they are going to produce it through iron ore or whether they are going to produce it through scrap or EAF or DRI. The biggest push for them is to produce low carbon steel. So, and they have upgraded almost 600 million tons of their capacity with low emission steel, what they call in China. And what they are doing now is to see what, and they are experimenting, like you are saying, they are experimenting with their steel industry, that what is the best way to produce the steel which is low emission. So you have seen now in last 1.5 years, China has imported a lot of semi-finished steel. For example, China has imported tens of millions of tons of slabs, 20 million tons of billets. These are all these experiments. Should we go for scrap route? Should we go for semi-finished, or should we go for blast furnace using more scrap? Point one.
Yeah, I mean, sorry.
Point two,
but Ved, I mean, some of that volume intake was actually in Q1 last year when it was coming out of COVID, and even early Q2 last year where China was coming out of COVID and they were actually short on ferrous units. So a lot of the semi-finished, a lot of the iron metallics that they brought in was basically because they were able to ramp up steel production a lot faster than they originally anticipated, and there just wasn't enough raw material on the ground, right? So, I mean, I understand what you're saying, but because I want to fight with you and I want to disagree with you, I'm just going to throw that out there that they were caught short on ferrous units, and that's what led to those big spikes early last year. So when you look at like 2020 volumes, it seems significant. And I think you're absolutely right. There's definitely a percentage of that, like, hey, let's bring in other things and see what we can do with low carbon. But I think that a significant percentage of that increase that you're citing was actually related to China getting caught on ferrous units, getting short on ferrous units early in the year.
They are in their peak, China has ever imported the maximum amount of scrap was 26 million tons. China has indigenous resource of around 430 million tons of scrap laying on the ground.
Yeah.
So I don't think so that China is going to be a huge actor in coming 2, 3 years or 4 years as far as scrap import is concerned. And secondly, like Nathan said, this new codes which they have invented, we did a couple of deals to China. We are also experimenting. We don't know if our cargo will be cleared as we have foreseen it, or it would create some problems of reshipment somewhere else, etc., etc. So everyone is actually seeing how it's going to move, and the scrap which China is aiming to import is already so short in the world. So, for example, if you're talking about busheling, if you're talking about P&S, there is a huge domestic demand in Europe. There is a huge domestic demand in US. There is a lot of scrap needed from US to Europe, from Europe to US. So, and Chinese are not willing to pay a higher price for that material. So I don't think so China is going to be.
But again, I think you make two excellent points there. One is the domestic prices in China for their own scrap is a lot lower than current, seaborne prices. So they don't really need to chase export pricing, correct? And then there's the taxes.
40% tax, Sean, because there is a 40% export tax.
Right.
You remove the tax, and the scrap prices will, I think people will be very pleased to export more scrap from China.
And I think the other thing that you raised, and I think that's really valid, is that actually, Nathan, I don't know if you're aware of this, but, China was on the West Coast looking for bulk, right? And a lot of there's not that many bulk exporters on the West Coast, as we know, right? But a couple of them were unsure on whether China would clear it. I mean, because of these new the new whatever you want to call it, right? The new classification of scrap. I mean, there's a lot of uncertainty. I mean, it's okay to send 1,000 tons in boxes, but it's a completely different matter to have a vessel of 35,000 tons, lying there because China won't clear the HMS, right? So.
I mean, let's call a spade, okay? You pointed to the West Coast. These are respectable exporters. They've been shipping scrap for 50 years, exporting to various markets. Do the Chinese buyers want to reinvent the wheel, create new HMS? I mean, it's absurd, to ship a cargo and to face a risk to have to take the ship back if someone decides that the quality isn't good. It's lunacy, absurdly absurd, absolutely.
Well, I mean, but they're trying to cut out impurities, Nathan. I don't think the US gets to tell China, hey, take our impurities, right? I mean, if China's trying to maintain a quality standard and says we don't want dirt, we don't want stuff that we think is polluting our environment, I think that any country's allowed to do that, right? I mean, why would that be an issue?
Of course they're allowed to do that, and of course we all want scrap. But one thing is interesting to notice: scrap does not come off a factory production line, although some of the Japanese scrap, I have to say, does literally come off a production line. You mentioned Japanese and Korean cargoes were sold to China, and that's very true, and it's actually very admirable how the Japanese can somehow conform to the Chinese idiosyncrasy, so those specifications for scrap. And yes, it's their right to insist not to have any dirt and impurities. But you know what? For most part, they are reliable and respected surveyors surveying these cargoes. And many just as respected steel mills across the world, from South America to Europe to Central and Southeast Asia, are producing high quality steel. So, I mean, you want to put all these restrictions on yourself. Okay, eventually you end up hurting yourself. That's the way this goes.
Okay. So Nathan, coming back to you from again, from your perspective, right? I mean, where are you seeing concern? Where are you seeing maybe activity pick up? Where do you see, where does volume kick in, right? For ferrous scrap hedging, right? Where do you see the opportunities?
Well, volume and the words volume and ferrous scrap hedging somehow don't seem to fit into the same sentence. If you're looking at the HMS, the Turkish contract that the LME has, it's a head spinner. How you hedge a 30,000 ton cargo?
Let's ask Josh.
So I'm not really qualified to answer that, but I believe Josh is very qualified to answer that. So I want to take a position. I'm a trader. I want to buy a cargo. I don't want to sell it. I'm taking a speculation. The market's going to go up or so. But how do you hedge 30,000 tons?
I guess my first question on that would be, do you really want to hedge the entirety of the cargo? I mean, in historic trade, right? I mean, if we're taking someone who's not hedging at all, they're wearing all of that basis risk on the position, right? They're not taking any of that risk premia outside of their physical position. Now, granted, 30,000 tons may take some time to execute in the marketplace, but you could easily plug in, I've seen 5,000 ton clips trade in sequential days before in the HMS market. So, I mean, if we're taking, instead of the full 30,000 tons, let's take a fraction of it, let's take half of it, 15 KT, you should be able to get that done within a period of time that, instead of looking at like month-long periods, like let's look at 10 trading sessions. I mean, should be very easily to execute that without having to make a move on the market from your position sizing. One thing that is important, right, is anytime a trade transacts, right, in the futures market, is it then becomes a data point that the rest of the market looks at and says, okay, someone comes in with a 5,000 ton order. If I'm selling it, put some pressure on the buy side of the equation to execute.
Yeah, but just let's bring it back to like the actual, to Nathan's point. I think because like that really is, everyone on the Ferrous side, that's their biggest concern, right? Like, hey, in my actual physical trading, one is how do I do this, right? Like to Nathan's point, where do I get it from? I mean, it seems like every time someone wants to come in, even if it's for 5,000 tons or 10,000 tons, it involves calling a physical broker, the physical broker calling a bunch of people, trying to make a mark. I mean, it just seems, I might as well send a fax or a telegram, right? It just seems very, 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 and then the other point is also the cost of the hedge, right? So why don't you speak to what's happening? I mean, there's a large audience here of Ferrous, right? So let's talk to what's getting better. How does it actually work? How does one remove the friction?
I think one thing that the scrap market needs to adopt, that we're seeing the steel hedgers really utilize, is this concept of layering in their hedges, right? So if I have, let's take the same 30,000 ton position, we have people on the steel side who have, equivalent, if not larger positions. And what they do is every day they come in and trade 1,000 tons, maybe 2,000, 3,000, 4,000 tons a day, right? And they're able to layer in their position on the time period that they need to execute that hedge. Now, in terms of the time concerns, I guess what I would identify is the best way to access the market is to manage your own clearing account, with a FCM futures commission merchant, and then go into the marketplace either through a broker such as ourselves, or using your network contacts who are also in the marketplace, and shopping that order around. Now, does shopping that order around take time? Sure. I mean, do you ever go into the stock market and just say, you know what, I'll take the market order and, see whatever happens to me? I mean, that's not really
but Josh, come on, I mean, that's really not fair, right? I mean, because a lot of the companies here, are doing non-ferrous also. In non-ferrous, they don't have to face any of these issues that you're talking about. They don't, I mean, they can actually go in and say, this is the position I want to hedge, and there's instant liquidity available, and they just do it. I mean, they call the broker if they need to, or they go on a screen and say, this is where we want to hedge, and it's done. You can't do that in Ferrous. So how do we get there? I understand that everything has a cycle, right? I mean, we're in early days of Ferrous. The question is, how do we get there, right? What do you see happening to bring us there from the Ferrous perspective?
I think it's important to note, on the non-ferrous side, you do have a lot of these physical intermediaries that will take some type of cut for executing that hedge. And they deserve that, right? I mean, that's part of the price negotiation for both the physical and the financial side of it. In order to have the volume growth that I think the market needs and demands, you need to have everyone not sit on the sidelines and wait for the ability to hedge, just a 30,000 cargo in a single day. Really, if you're looking at it in terms of moving risk off your balance sheet into the marketplace, I mean, what's the issue in opening up 1,000 ton positions and getting yourself comfortable? No one knows in the marketplace what you're doing. No one knows what you're exactly hedging with that mechanism. But if we all sit around waiting for some big entity to come in and start making that market, I mean, that's like waiting for pigs to fly. I mean, I don't think that's going to happen where suddenly someone's going to come in and the market's going to explode. I'd love that to happen.
But anecdotally, right, empirically, I mean, if you look at it, that's what it took for LME's aluminum contract to succeed was, after 9 years when Alcoa stepped in and decided to start using that P1020 contract, so it took, just today LME aluminum is referenced, it's got so much liquidity, but it took them 8 or 9 years, if maybe 10, it was only until Alcoa. So it did take that big participant to come in and support it, right? So let's see what happens with Ferrous. But taking that to Ved, now Ved, you have a large position, right? I mean, have you looked at Ferrous hedging? I mean, what are your views on it as a company, right? Like, where do you see it not working or working? What's your view on it?
So I did try 2 times hedging my position, and both time actually I lost, both on physical and on the paper as well.
Well, hang on, wait, but that's not fair. I mean, if you did a true hedge, you could have lost on the physical, but hedged been hedged on the financial. I mean, there's no way you lose both.
Yeah, I lost on both. 2 things. First, it was based on a Turkish index, but the cargo was actually going to India.
Well, you have basis risk there.
So you had basis risk, okay.
Yeah, because there is no India contract there. I know now. I think S&P is trying to make up something based on Indian trade. They are kind of
There's some stuff coming for Asia. That's right. Yeah.
So the cargo was actually going to India, and the only reference point was Turkish index. And somebody a good salesman like Josh sold us that concept, and we bought that.
Hey, I don't know if I would have sold you a Turkish number to hedge you in.
Not you, somebody like you.
Yeah, fair enough.
I think we were just trying to taste the water. If it was really
guys,
working.
We've just received a little heads up saying we've got 10 minutes to go. So one of the questions that has come in from one of the attendees is, I don't know which one of you wants to do this, but okay, can we expect Ferrous prices to hit $600 CIF by August? There is no destination mentioned here, so I don't know, because like Bangladesh is already at 540, 550, for bulk shred. But yeah, the question is, does scrap hit 600 by August? So I don't know which one of you wants. Do any of you have a working crystal ball right now?
I don't have the crystal ball, nor do I think it's appropriate to discuss prices in this forum. Based on what I've read before, I agreed to get on here. So
okay.
Anything can happen.
So let's talk. Okay, so let's not go pricing. Let's talk about bullish or negative, right? So in terms of market sentiment, okay, actually, you know what? Here's where we can probably use some of Josh's data, right? Josh, what are the derivatives? So what are the forwards telling you in terms of scrap futures?
Yeah, look, heavy melt and the rest of the steel suite has been backwardated, right? Meaning nearby prices are worth more than the deferred prices.
Okay, so that doesn't bode well for this question.
I'm sorry?
I said, so that doesn't bode well for this question then?
It doesn't, but one thing that's important to note is that those forward prices, right? So let's take the August futures contract. All that's representing is all of the available market data today, right? So it's not a predictive entity, but rather the market opinion for that point in time today.
Yeah, but people, people have today bet on a price tomorrow, right? So what are people betting on? What is the futures price?
It's moving downward. So based on that data, I would say that 600 is less likely, and maybe even we're taking the Turkish number here, right? Let me just make that note important, because that's where you trade.
Right.
It looks like right now that even let's call it like 500 may or may not be in the cards, just based on where transactions have been booking.
Where futures are trading. Okay.
Exactly. Yeah. 490 traded yesterday.
Nathan, near term, like next 30 days, let's call it a 30 to 45 days. Actually, let's do 30 to 60 days, right? 1 to 2 months is way. What's your sentiment for the next 30 to 60 days?
I just think that I had recently a look around the world and different projects and government projects and private projects that are about to go up and to be built. And I think it's fair to say in general that the demand for steel across the globe is looking very good for now. And that means that the demand for scrap is looking good at the moment. So yes, you'll go through periods where price adjustments will happen, and there'll be some corrections, and it'll drop 20, 30, 50 bucks or so. It could even drop $100 when you're up at $500 or so. But I think it's fair to say that the demand for scrap across the globe is looking good. And I say that based on the fact that I know the demand for steel is looking good. So that's why I'll leave it at.
Next 30 to 60 days, sentiment, let's not talk about pricing. What do you feel?
I think the sentiments are strong. And one important thing, San, I think we didn't touch that topic. The scrap business is becoming a very domestic business nowadays. Everyone is talking about their own domestic market and export ban and et cetera, et cetera. Even I recently came across an article from Eurofair where they are saying that they should ban the export of scrap to those countries who are not meeting the carbon standards of Europe. Same as US doing. So scrap is now becoming more and more domestic centric business. So, and if you have a strong domestic business in any of the countries, then of course it will have an impact on international trade. That means the prices would remain strong. Yeah. If the countries like India, Bangladesh, Pakistan, who are totally dependent on imported scrap, have to import the scrap, they have to pay the numbers.
Right. Yeah. I mean, I think you're right. Yeah, the Euro thing. I mean, it's amazing if that happens. Like, I think that's, personally, I think they've missed the mark on that one if they ban exports out of Europe. But I mean, anyway, I think there are enough steel producers and countries fighting that. What we're hearing is that the US domestic market sentiment for July is bullish. For Europe, it's bullish. So, you're absolutely right. Domestic markets are strong. I mean, steel's at $1,600, $1,700 in the US for HRC. It's at $1,200, $1,300 in Europe, I mean, but obviously I think it's the long product producers that are unable to support higher scrap prices because long products are still at around 900, 950, right? So, I mean, if rebar, was also at 1,500, we'd be in a much different scrap market today, right? So, but okay, great. So I think we can end this now. I don't know who's here from IRW to tell us to push off. But Josh, Nathan, Ved, thank you so much for your time this morning. This afternoon for Ved, he's the lucky one. He's already looking at lunch. But okay, so we'll say, I'm going to say goodbye to you and goodbye to everyone that joined. Thank you so much, everyone, for your time. I hope this was of some use to you, and we look forward to your feedback. Thank you, everyone. Bye.
Thank you, Sean.
Thank you,
guys.
Bye-bye.
Bye.